Hey, welcome back, everybody. We got another webinar on deck for you here. My name is Patrick, and as always, we're hoping to provide a little different perspective and outlook here on the markets. Keep in mind everything we talk about in the videos for education and example purposes. Make sure that it fits within your risk tolerance. Let's kind of just talk about where things are at here in the markets right now. As we all know, harvest is wrapping up, and guys are looking at either continuing to look at on-farm or commercial storage. We've had quite a few questions about carry in the market, so we're going to kind of cover that topic here today. Uh, as far as corn goes, we have the December futures price, March futures price, carry, and then full carry. So you can see in this chart, we're running about 40 to 50% of full carry. So again, you're not getting paid full amount to store your corn. This can vary, of course, person to person, but ultimately the interest rate is essentially non-negotiable. And at the end of the day, whether you store in commercial or on farm, you should be paying yourself some sort of interest rate. So keep that in mind. But nonetheless, guys are continuing to store, and that's fine. We just want to, make this point clear that the carry is only about 50%. Same on the bean side of things. But anyways, now that we're back into kind of these carry markets, how do you capture carry? Well, it's really simple. You would just sell the deferred futures month. And so in this perfect example here, you could, rather than sell the December corn futures at 470, if you wanted to capture the carry, you would sell the March contract at 489, capturing that 19 cents with the carry in the market. Now, as we saw from the previous slide, full carry is 32 cents. So you are giving up the potential for full carry. Of course, it could narrow as well. So with everything, there's always trade-offs. The other thing you could look at is a fence position. What you're doing here is you're buying a put and then you're selling a call at the same time. Why you're doing this is it cheapens the cost of your downside protection. So if the market goes down, you're not getting you don't have a big expensive put out there. On the other hand, if carry were to widen, you get to participate in that move a little bit if the market runs up to that sold call or ceiling price. Keep in mind, and we have to emphasize this is a marginable position. So not only do you need a budget dollars, for that initial margin, but if you go beyond that, there's a good chance you'll be on margin call to produce, to deposit into your hedge account as well. There's certainly nothing inherently wrong with that, but you do need to be aware of it as you plan if you're going to put this position in place. So just wrapping things up, we're keeping it short. What are you comfortable with? As always, that's what we start with. Do you want to make cash sales only? Do you want to store with puts? Do you want to store with the fence? Do you want to do nothing? Formulate a plan. Oftentimes what you'll see in carry markets is as the nearby month starts to come off the board, it will move back or move to where the previous month sold off. In other words, the carry starts to disappear. So keep that in mind. Again, why we like maybe doing that fence position. So you have a price floor on the carry of the market, if you will. And then lastly, you could certainly do like some sort of mix and match combo, diversify your risk a little bit. Maybe you do 30 to 50% of your bushels on a fence and the rest in cash. If you're still with us, let me show you how that looks here real quick. This was a producer, 70,000 bushels. We went out to the July contract. This is 50% of those bushels, so 35,000 on a fence. A $5 550 fence costing about 10 cents. As you can see down at the bottom, the wide range of price availability. Supposing you not only hold this position until the end of June when these options expire, but then that's when you make your you make the rest of your cash sales as well. So if you want a wide dynamic range, if you will, on what price you might be able to receive, maybe the 50% option is for you. Now you can compare that to a 100% fence option, 70,000 bushels here, and you can see the price range, of course, is much more narrow as that's what the point of the fence is. You have a floor and a ceiling. So again, if you think maybe this is a better fit for you, this could be something you consider as well. We appreciate you guys tuning in. Be sure to reach out to us if you have any questions. We hope everybody has a fantastic and safe Thanksgiving. And always, we appreciate your business. Don't forget to hit the like button and please subscribe if you enjoy the content.